Hello everybody, welcome back to another video on my section of the videos. This is the first video of section 2 and we're going to be discussing structure, right? Which will be your kind of roadmap to directional bias and your roadmap to identifying transitions, right? Now there's two ways we identify transitions. There is basic structure and trend, and there is also liquidity, right? And I'll go through liquidity more on the next section, but for this section, I'm going to basically be talking about structure and what it is, the structural rules, going through very quickly the transition framework and graphical examples, right? Now, the whole kind of premise of the way we trade is basically the study of transitions, right? Now, if I go on to basic transitions, and what it's derived from is the Wyckoff logic, right? If you don't know about Wyckoff, Richard Wyckoff was an ex-investment analyst or investment banker, and he basically, I don't want to say he invented these styles, but he definitely identified them very early on, and he has a few different schematics and stuff like that to identify 4 different phases, right, which would be the accumulation, markup, distribution, markdown. Now, I'm not going to go into the whole kind of, the PSSY, or, all this stuff, all these things, because it's not relevant at the minute. But basically, an accumulation is a bearish to bullish transition. So as you can see here, price was trading down, and then we had a transition up, so bearish to bullish. And then a markup is bullish to bullish. So we have maybe some kind of like stagnation here, and we see a transition on this section, and then we go higher again. So we're not actually going down, we're going higher after a move higher already. So it's bullish to bullish. And then distribution is our bullish to bearish transition, and then a markdown is our bearish to bearish transition, right? And as I mentioned earlier on in the video, you can identify these via structure and liquidity, right? But these are the 4 things we'll go through in this video, just what structure is, structural rules, transition frameworks, and just some examples on the charts, right? Again, some of you, or most of you, will know about this. Those that have obviously been in RCV or Corsica for a while. Those of you that have just joined or are studying the videos for the first time and you're kind of not aware of this, Fredo's obviously done a video on this as well. But again, I've been told that my teaching style and my delivery is quite different from Fredo's. So if you guys might benefit a bit more from my style, some of you may benefit a bit more from Fredo's style, but I'll go through it anyway and let's get into it. So an introduction to structure, very simply, what is structure? Simply defined, market structure or structure is a blueprint of the direction that the market is moving in, also known as a trend. A defined trend is classified via its highs and lows, right? And it's also a blueprint to identify a transition, right, for you to then execute your trade, right? And direction, liquidity, execution is the 3-step framework for trading this style. And direction comes first, as you can see, and direction is derived from structure, right? Then liquidity, and then execution, which we'll obviously move into a bit later on. Okay. Now, very simply, again, I know this is very basic stuff, but it's stuff you cannot just let go unnoticed. You need to always be aware of this type of thing. An uptrend is characterized by higher highs and higher lows, as identified here. A downtrend is characterized by lower highs and lower lows, as identified here. No man's land, or NML, or just an untradeable environment, would be basically a structural formation like this, where there's no defined higher highs or lower lows, or lower highs or lower lows, or whatever it is, or higher lows, right? As you can see here, it's very messy. There's no kind of definitive answer to where price is going. So this is what you'll get, and that's what we refer to as no man's land or NML or whatever it is, right? Now, it's advised you don't trade in this because you don't have a set direction, and a rule of thumb is you always want to trade within direction. You don't want to be basically taking a guess on where price is going to go, because this story doesn't tell us pretty much anything, right? Because when there's no classification of a higher high or a higher low, or a lower high or a lower low, you don't know where the market is going, very simply, as again most of you probably know already, right? So it's advised you don't trade in this. If you do trade in it, make sure you acknowledge your risk. You're aware that, you know, you're basically taking a guess on where price is going, and you know, the potential to lose is probably a lot higher in this environment than it would be in these two environments. Again, a very standard rule that we stick by is usually an 80-20 rule, right? 80% you want to be trading continuations or just a trending market, and 20% of your trades could be reversals, right? Now, that doesn't mean, you know, because you've taken 8 out of 10 trades continuations, you can then take 2 trades that are reversals. If the opportunity arises, just keep in mind this kind of statistic over here, right? And it's always advised that you want to be taking way more than continuations than reversals, right? Or in this case, say a no man's land. You want to be trading ideally these environments, especially as a beginner. You'll see your win rate go up a lot more in this sense, because you're basically, if you're trading in an uptrend, you're basically eliminating one direction of the market. So the only way you're really going to lose is if there just happens to be a reversal on the time you're trading, or if you just entered at the wrong place, or your stop loss placement is wrong, right? If you're selling here, you run a much higher risk of price just continuing going higher, right? And another thing that I like to kind of stick by as well is you always have to assume that price is just going to continue to do this, this, and this until it doesn't, right? So until you see something that says price isn't going to continue, then that's when you can look to shift your bias, right? But you can't just guess. If price is coming down here and there's not been any real kind of CBOS, RBOS, or anything like that, which we'll speak about in the next video, then you selling here is a pure guess, and it's basically the same as trading here, right? Because you're taking a guess that price is going to then reverse with no real reason, if there isn't a reason, of course. It's the exact same here. If you're taking a buy here or a sell here, you're guessing that price is going to go in that direction without any real confirmation. All right. So always assume continuation until you see it won't continue. So let's go on to some graphical examples now, again, of just some very simple structure, right? So as you can see, price is trading down. We had our transition occur over here, which then says to me that I can assume price is going to reverse from this downtrend and we're going to go higher, right? And then price continues to go higher. Now selling in this, now this is obviously on the 1 hour chart. If you're trading on the M1, you're going to see downtrends occur over here, and you can of course take a sell in that if you're trading on like the 5 minute and below. But let's just assume that you're trading on the H1 as your executional time frame. You're not going to be selling here, right? You don't want to be selling in this environment because price is trending upward. Okay, can you just see by the simple elimination of selling in an uptrend or buying in a downtrend can automatically increase your win rate quite a lot just by taking the correct direction in your trade, right? Higher high, higher low, higher high, higher low, higher high, higher low, and so on, right? So if I was trying to sell, say, every time price was pulling back, I would have maybe made a little bit of profit, wouldn't have hit TP, and I would have just lost, right? If you're buying, say, at every point where price reversed that, win, 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 right? It's just very simple stuff. I know this, but again, it's something you guys need to ingrain in your brains. Vice versa, of course, with the downtrend is we had an LG continuation here. So we've got a high, a lower high in comparison to this high. You might be thinking, why have I not selected this high? Again, we're on the H1. If I was on say the 15 minute, then this would be a lot more prominent, and I could then take into account all the potential highs and lows that are within this big leg, because you have to remember in the H1 time frame, you see this big move, right? But on the, let's say the M5 time frame, you're probably going to see something like this, right? And then these will all be characterized highs and lows over here, right? So you get a much bigger picture when you zoom in. It's all the same data, just you're getting more of it basically. But the reason I'm not taking into account this is because the highest point within this whole leg here is here. So I'm just taking this high to this low, to this high, to this low, to this high, to this low, and so on, right? Because these are the most external significant swing highs and swing lows within this trend. Okay, here and here, and here, and here, and then price just continues to roll, right? And again, it's the same thing. If I was trying to guess a buy within here, I would have lost basically every single time, and it's just not worth doing it, right? Sell in a bearish market, buy in a bullish market, keep it very simple. Again, this is the H1. If you're on the M1 and you're seeing something like this, where price is pushed down, we failed to actually take that low after making a high. We've got an intermediate term or a short term uptrend in this case. On the M1 or the M5, you potentially could take a buy opportunity, say within this region for whatever, and target this high. That's fair enough. But if you're trading on this scale, let's assume this is the M5, right? You're definitely not going to be buying that if you're trading on that time frame. If you're trading on the H1, you're definitely not going to be buying this. You're going to be waiting for a pullback into the inefficiency, stop losses above your invalidation, TP is going to be below your low or wherever it is, and that's that. And just a kind of example of no man's land, again, it's just, there's no real kind of definition here of where price is going, because we have here, clearly we have a high and a low, but we have a lower high, but a higher low. And to identify a trend, you want something like this, right? Whereas we have something like this currently. And then we get a higher high. And then we get a lower low, as you can see here. So we're like this. And then we get a higher high. So we're like this. And then we get a I don't think we actually do it on this here, but we get a low basically traded all the way down here. And there's no real defined setup like there is here. So advisable to stay away from this. Again, this is the M5, so a short-term trade, say after this transition over here, you get an LG break of structure, reversal, potential trades could occur there, and only if you're targeting this point, right, stops above there, then that arguably makes sense. But again, it's just running that risk of potentially seeing, okay, we've also taken this low, broken this high. Are we now in this market going here? Are we going to continue higher? There's always that risk. So it's just a very messy environment. And again here, like I've drawn it out, a NML or a no man's land is usually classified by like a kind of zigzaggy motion or triangle patterns. I know that's something that's spoken about. There's just not any real definition. And the way that I would kind of suggest that you offset kind of becoming a victim to this is, number one, don't trade it. And then two, if you do want to trade it, I would wait for something like this, right? So let's assume the triangle pattern's like this. And then usually what the kind of, I don't really like using this word, but the retail will say is basically as soon as you get a breakout, you can then trade and then go forward, right? Now this breakout doesn't always mean, or this push up doesn't always mean it's going to like go higher. What I would recommend you do is just wait for a break and then wait for a pullback and then wait for another break, just to kind of give you that confirmation here, because then you have a full set trading range here basically, right? And then you can potentially look to trade that, and then your stops could be either below here or an aggressive stop could be below here, and then go from there. Or if you're just not comfortable at all, then don't, right? But that's pretty much it for an introduction to structure, the different types of trends there are, uptrend, downtrend, no man's land, and just an overview on the whole transition side of things, right? But the next video, we're going to go through the CBOS and RBOS, basically what they are, and we're going to go through the actual BOS as well, which is break of structure. So I'll see you all in the next video.